I'm Sarah Skina with McGohan Brabender. I work in our business development team. We're so excited to have all of you here this morning to learn about the ACA reporting and what's coming down the pike for everyone. We actually have 3 speakers today to make sure we cover this from a few different angles. First up, we'll have Paul Roth. He's an attorney with Dunleavy, Mahan, and Furry in downtown. Many of you already know Paul, so I'm sure he doesn't need much of an introduction.
Infamous Paul.
We also have Grant Reed joining us today. He's hiding in the cubby over here. Grant is our Director of Financial and Analytical Services here. And in order to spare you from listening to both an attorney and an actuary banter back and forth this morning, we have Beth Bailey, our Director of Account Management, joining us this morning. So we'll have 3 speakers. We have a lot of information to cover, so I'm going to stop talking and kick it off with Paul this morning. So thanks for being here.
Thanks. I applaud your tenacity because these forms are killers. I'm not kidding you. I'm a CPA and I got out of that a long time ago. I'm just thankful, even more so than before. But I'm going to talk about 3 topics today that really don't have to do with the Form 5500. It's pretty current and it will impact you. So let me get into it. Basically, what happened is with healthcare reform, one of the requirements is that they put a cap on the maximum out-of-pocket for essential health benefits. And essential health benefits is a category of 10 pretty broad services. And basically, the thing with healthcare reform is it said that there's going to be a cap on the maximum amount that a person has to pay for essential health benefits provided by an in-network provider. What the government slipped in the other day is saying for plan years beginning on or after 1/1 of 16, it's an embedded out-of-pocket maximum out-of-pocket. And basically what that means is that no one person has to pay more than the single maximum out-of-pocket. And I have an example in here. For 2016, it's going to be $68.50 for single coverage and $13.7 for family coverage. It's just, let me say 7 and 14 because it's close enough for government work. But basically what I'm saying is if one individual had $10,000 worth of claims, because it's an embedded out-of-pocket, the plan's going to have to pay for the amount over the $7,000, even though we didn't hit the 14. Okay, so that's what that is. The professor, Grant Reed, says that's going to cost you about 3%. That's about a 3% hit in the premiums because of that. And again, it applies to all non-grandfathered plans, large, small, fully insured, or self-funded. Okay, and I gave you an example here. Okay, let's talk about the 2 U.S. Supreme Court cases. Big deals. The first one was with respect to the premium subsidies. And when the statute was enacted, they had envisioned that the states would establish their own exchanges and that there would be subsidies for lower or moderate income people to pay for the premiums. So what happened, again, the statute was passed and they said, okay, we'll have these premiums and we'll have it for state-run exchanges. And they anticipated that the states would establish the exchanges. But as it turned out, a lot of states, in fact, about 36 or 37 said, I'm not going to do that. Basically, they were a lot of Republican states. They said, no, I'm not going to do that. So the statute says if the state doesn't set up the exchange, the federal government will. Okay, so the federal government set up these exchanges in about 36 or 37 states. But the statute said you only get the subsidy if it's a state-run exchange. So then the IRS said, we're just kidding, and we're going to pass a regulation that says any exchange. Well, here's the big deal with the Supreme Court case. They basically ruled that, yes, whether you're in a state or federal exchange, you'll get the subsidy. But what the interesting part is the lawsuit was the IRS didn't have the authority to issue that regulation, okay? What the Supreme Court said is we're not going to actually rule on that case. What we're going to do is we're going to look at the intent of the law. And the intent of the law is that that subsidy should be available to everybody. And therefore, again, the subsidies are available under a federal state-run exchange. But the important part to note is because they said we're not going to really rule whether the IRS had the authority to do that. We're just going to look at the intent of the law. Had they looked at the case that was presented before them, whether the IRS had the authority to do that, and let's say they would have, and they would have said, yes, they do, then another administration could have come in and changed that regulation. So by saying that it's now the intent of the law, it will literally take an act of Congress to change it. So if they just simply would have said that regulation is okay, the regulation could have been changed much easier than the law. So that's the big deal about that. Okay, let's talk about the sexy stuff, because Lord knows the forms aren't going to be that. Basically, what the court said, and I'm going to have a lot of contradictions here in a way, but just bear with me. What the court said is that the states and their instrumentalities, which basically municipalities and stuff, they have to recognize same-sex marriage. Okay, so like Ohio was one of the states that didn't. So what they said is that the states have to recognize same-sex marriage. It didn't really, or wasn't directed at private employers, okay? It was directed at the states, not the private employers. But that doesn't mean the private employers are off the hook. Because what happens is, again, all states, including Ohio, have to recognize and grant same-sex marriage. Now bear in mind, remember in 2013 there was a US Supreme Court case that said the Defense of Marriage Act was invalid. What that said, or what the impetus of that, is that for federal law purposes, same-sex spouses were the same. So now the court is saying states have to recognize this. So what does it mean? Again, technically speaking, it wasn't directed at private employers, but again, it has a major impact on them. And what you're seeing is the EEOC is starting to take an active role in this. And they're saying that sexual orientation is perhaps a violation under Title VII of the Civil Rights Act. So the starting point is, okay, I'm a private employer, that court case doesn't really impact me. But it does, because a couple things. If you're fully insured, the state governs or has laws that govern the carriers like Anthem United and those. They could have a provision that says if you're going to offer a certificate, you have to cover same-sex spouses. They haven't done that yet in Ohio. Okay, now some of the carriers are doing that, but a couple things. So if you're fully insured, and even if you're self-funded, you have to follow your certificate, the certificate of coverage. So if it says, if you're work 25 hours a week or 30 hours a week, you're eligible for my health plan. If you're eligible for the health plan, your spouse is. If you have that kind of language, you would be inadvertently, or whatever, you're going to cover same-sex spouses. A lot of certificates simply say a legally married spouse. Now that's same-sex spouses. So you're going to get dragged into that. Again, if you want to exclude same-sex spouses, you would have to have that in your certificate. And again, in the context of a fully insured plan, that may be a tough road to hoe. For a self-funded plan, you probably could do that, but again, if you just simply say legally married spouse, then you've pulled them in. Even if you want to exclude them and you're self-funded, you're probably a little bit on shaky ground because again, this is a hot area, the EEOC is getting involved in it, and again, you can always have a private lawsuit on top of that. So, I guess we're going to have questions afterwards. And with that, I'm going to turn it over to Beth. I appreciate it. Be back for the Q&As. You clap because I'm getting down to that.
All right, good morning. Everybody hear me okay? We've got a big room today. So I have the honor of speaking to you about these lovely new ACA filings. Exciting stuff, a lot of detail. The devil is in the detail, so when I'm speaking, I'm going to try to deal with the most common scenarios, okay? So, there's so much in the tiny little details about how you handle certain situations that we could be here all day. So we're going to take it from a broader view just to help, hopefully, most of you walk out of here with a level understanding of at least what needs to be done, when it needs to be done, and how you might approach it, okay? Not legal or tax advice. I'm not an attorney. I'm not Paul, certainly. Don't aspire to be, nor am I, Grant. I'm not an actuary. I'm coming at this from more of a practical basis, which I think is the basis that a lot of you are coming at it from as well. If you have over 250 forms that you're going to be filing on the 1095Cs, you have to use this electronic submission process with the IRS, and they've dubbed it the AIR process. It's going to be complex. They're also going to want personal information. That's why I put on there, remember, health plan ID. Some people really started freaking out when that process was still a valid process and they wanted personal information to get registered. this is going to be the same way. So just to prepare you for it, that's out there. Okay? Consider partnering with an outsourced vendor if, especially, you have to do the electronic filing. Again, it's going to be a tough process. You may want to, look at what's out there, who's available to partner with. Your account managers here at McGohan can certainly, help point you in a direction for you to consider, and we can take it from there. Okay. Some of the information we want to make sure we're considering: who's tracking this information? A lot of information to report. Who's doing all the tracking? What system is it in? How many systems is it in? How am I going to pull it all together? What affordability safe harbor am I going to use? W-2, the federal poverty line, mainland number. There's a few different ways to go there. Do any of the simplified reporting options work for me? Probably not, but they're there. And again, who's going to perform the filing? So just a quick recap. We want to talk about the employer mandate, just a refresher on exactly what that is, so we can kind of level set on what we're going to talk about moving forward. The final rules were released on the reporting in March of 14. And the minimum essential coverage is the 60-55 reporting. It gets confusing because we've got a lot of numbers, a lot of acronyms. Okay, we've got 60-55, 60-56, 1095C, 1094C. So we'll talk broadly and then we'll narrow down to the specific forms. These are the code sections. Okay. The 60-55 report on minimum essential coverage, that is more so the IRS knows whether or not the individual is going to be subject to that individual penalty, that tax, for not having coverage, okay? The 60-56 is reporting by the ALE, which is the applicable large employer or the ALE member, and they're going to use it to calculate potential employer penalties, but also to determine individual premium tax credit eligibility, okay? And then we're an acronym soup here, so ALE, applicable large employer, which hopefully people now recognize that that is any employer with 50 or more full-time or full-time equivalent employees prior calendar year or prior year. And then minimum essential coverage is basically any group plan for this purpose, okay? We're not talking quality and affordability yet, we're talking broader. So employers must offer minimum essential coverage to full-time employees and dependent children to the end of the month in which they turn 26. Everybody in this room should be, hopefully, most of the people in the room should be 100 plus, some fully insured, some self-funded, but we're speaking here from that large group perspective. So for 2015, we got a little bit of a relief that a lot of folks took advantage of, in that you only have to do that for 70% of your full-time employees, okay? A little bit of transitional relief, and that is to avoid that overall penalty, that overarching penalty on every one of your eligible employees, right? All those full-time employees, that $2,000 penalty. So if you offer this minimum essential coverage based on the guidelines that they define, you will avoid that overall overarching penalty, what they call an A penalty, okay? Next year, 2016, right now, it's supposed to go up to 95%, okay? That's going to be tough. That's a very little bit of slush that you have to deal with as you're working through it. So we got a little bit of a reprieve. There's, of course, legislation out there asking to extend that 90%, but as of today, we're sticking with, to extend the 70%, we're sticking with the 95% going into 2016, so just to prepare you. Applicable large employers, or ALEs who self-fund, you can satisfy both the 60-55 requirements and 60-56 requirements when you satisfy the 60-56 requirements. So you don't have to worry about the separate 60-55 requirements. It'll be all handled through the 60-56. Okay, providing a few more informational type slides for you. Some folks are visuals, so this might help you. On the left side is self-funded, really the right side fully insured, if you're looking at it the way I am. So do you offer MEC under a self-funded plan, yes or no? And then it works down, okay? If you do, you're subject to the 60-55 reporting, no matter what your size is, okay? So even those smaller employers that choose to self-fund still have an obligation here. Working down, now it's asking, are you an applicable large employer or an ALE member? Yes or no. If you are,
you're subject to both requirements, okay? On the other side, if I'm not offering MEC under a self-funded plan, I'm not subject to the 6055, but if I'm in ALE, I'm going to have the 6056 requirements, okay? We'll come together on the next slide, I promise. Lots of numbers. Okay, so this is just a continuation of the first slide. I just couldn't fit it all on one slide and have you read it. So picking back up again with, are you an ALE member on the self-funded side? Got both requirements, okay? If I'm under 100 in self-funded, again, just the 6055. But here's where it gives you what actual forms you will need to complete, okay? So applicable large employer that self-funds, 1095C to all employees by technically January 31st, but next year, because of the way the calendar works, it's February 1st is actually your hard deadline, okay? And basically you follow the W-2 guidelines, very similar guidelines here. 1094C, which we'll talk about in a minute as well, is more that cover sheet, and you're going to use that to send your 1095Cs to the IRS. And that's due, if you're over 250 forms, by the end of March. Otherwise, it's due by the end of February if you're filing paper. Okay, so under 250, you are permitted to file paper, and there's an actual claim address or an actual IRS address in Austin, Texas, I believe, in the instructions that you would mail these to on paper. You're welcome, if you're under 250, to use the electronic process. You know, up to you guys to weigh the hassle factor there. If I'm not an ALE, I've got the 1095B to employees, which we're not going to talk much about the B forms at all, I just listed them here, and the 1084B to the IRS with the 1095B. It's very similar, just not all that detail. On the fully insured side, again, I have the 6056 requirements if I'm an ALE. So very similar here, 1095C to my employees by 131, 1094C to the IRS with my 1095s by the end of March, end of February if you're filing paper, okay? And if I'm not an ALE and I'm fully insured, the carrier's going to take care of it, all right? So no required reporting on the employer side. Different way to look at it. So I just tried to provide some tools for you to have, no matter how you wanted to look at it. So this basically gives the exact same information as the flow chart, except it goes into a little bit more of the other forms that are available. But you can look down here, and it basically shows ALE, fully insured, what you're required, ALE self-funded. The big difference, large employer, between fully insured and self-funded is Part 3 on the 1095C. Okay, that's all the detail of your covered members. Fully insured folks don't have to worry about that. Self-funded employers do. So we're going to focus today on the 1094C and 1095C. Again, that 1094C is a transmittal form to the IRS, so think cover sheet, but there's a lot more information on it. Okay, so it's more than just a cover sheet. It's going to take some time to work through and complete. But the 1095Cs are those individual statements that you're going to give each employee. Fully insured, each full-time employee. Self-funded, each employee covered under the plan. So even if you're covering part-time employees under the plan, you have to provide them a 1095C. And it says there, one of those little hints. So trying to help call out certain things that might be specific that might help you get through it. One form per ALE member for each full-time employee. We're going to start with the 1095C because they're due first. So deal with the bigger form with the more details first. So one form per ALE member for each full-time employee. Okay? One of the things that comes up here, what if my employee worked for two different divisions of my company? You must combine that, right, into one 1095C for that employee. If you're part of a control group, which we'll talk a little bit more about in a few minutes. I'm not going to get into a lot of detail on control groups, but if you have an employee or if you're an employer that's part of a control group and the employee works for two different companies, full-time in each company, you're going to have to provide, they would get two separate 1095Cs. So there's different rules around where your employees work and how they're broken out. Okay? Part 1 on the 1095C is pretty simple. looking for name of the employee, address, social security number. No, they kind of contradict themselves as they go through here. So here in the instructions it says social, no dashes. You're just going to complete the social security number of the employee. You've got your employer information on the right-hand side, the name of the employer, the employer identification number. They want the dashes there. Go figure. Street address, contact information. So number 10 wants a contact phone number for the employees to call if they have questions on why they're getting this form. So you need to figure out who that lucky person is within your organization or potentially within a vendor partner. The instructions really aren't clear on whether you're permitted to use an outsourced person, a TPA, or a vendor for this. So hopefully when they issue the final instructions for 1095C, they will tell us. Right now, we've got draft forms for 2015, but they are draft. You can see the drafts were released in June of this year, so they are not final. They didn't change a whole lot from the 2014 forms, but we only have 2014 instructions. So there are some things that are not clear that we're hoping they're going to clarify when they finally release the 2015 instructions. So it gets interesting, but yeah, that contact phone number is going to throw some people, so you might want to give that one some thought so you can figure out who that lucky person gets to be. Okay, part 2 we're going to spend some time on. This is the meat of the form on the 1095C. Both fully insured and self-funded groups need to complete this section, okay? Lots of detail here, lots of codes, so it gets fun. So we're going to start with line 14 and kind of work our way down. So part 2 deals with the offer of coverage. So it helps in your brain if you kind of think about what you're reporting on. So part 2 of 1095C is offer. What did we offer the employee? Doesn't matter if they took it or not. What was the offer of coverage? Okay? Line 14, you're going to use these Series 1 codes. Okay? So you're going to report on what you offered them. Right? And they try to give you different scenarios that will match that particular employee's situation. All right? There are 9 different codes. The most common scenario, and what you're going to find is, 80%, depending on your organization and your turnover and all that, 80%, 90%, 70% of the forms, you'll be able to use one code, right? And check the all 12 months box, and that's good, right? It's the exceptions that are going to take the time and make you pull your hair out. So 1A is going to be that most common code that you're going to use in this section where you make a qualifying offer. And that's minimum essential coverage, providing minimum value. Again, these are all healthcare reform terms that are defined. Minimum value is a plan that pays at least 60% of the cost of benefits. So minimum value would be that bronze plan that hopefully you've heard about or we've talked about in the past. If you offer that to the full-time employee and their contribution for self-only coverage is equal to or less than 9.5% of the single federal poverty line, mainland, because if you look at Alaska or Hawaii, they're different, so you gotta look at the mainland cost, and at least minimum essential coverage offered to spouse and dependents. All right? So even though healthcare reform didn't dictate you covered spouses, to consider it a qualifying offer, you have to offer minimum essential coverage at least to spouse and dependents. Okay? So again, the vast majority of the forms will be able to check the all 12 months box here and not worry about the different months here. So they would put that code 1A there and go on to line 15. The plan start month at the top is one of the things that's new for 2015 forms. That wasn't on the 2014. It's optional, so you don't have to do it for your first round of reporting, but it'll be considered required for 2016 reporting that you'll do in 2017. Not a big deal, it's just what your plan year. Is it an 01, is it a calendar year plan? Pretty straightforward. For line 14, those Series 1 codes kind of deal with the oddball situations, the different situations, okay? So, 1B, 1C, 1D, it goes all the way through 1I. You can kind of look through those. Again, they're going to apply to specific situations. it talks about, we're only offering coverage providing minimum value to the employee only, or we're offering it to the employee and the dependents but not the spouse, those kind of things. The one that I think you'll use if you cover part-time employees is 1G, okay? And if you cover part-time employees under your plan and you made them an offer of coverage, again, this is offer, not coverage, I gotta be careful in my terms here, but if you offer that part-time employee and they enrolled, you're gonna enter 1G. If they were enrolled for 1 month, or 2 months, or 3 months, you'll enter 1G in the all 12 months and not worry about it, okay? So you're just showing them that you have part-timers and that particular part-timer was on your plan, okay? 1H is no offer. So maybe some of those variable hour people that you made a conscious decision not to offer them the coverage because you had that 30% slush the first year, could be that situation. And then we'll talk about the transitional relief in a few minutes, okay? So this is where it starts getting into that detail where it's gonna be a bit harder to go, quickly through the forms. If you used any code 1B through 1E on line 14, then you would complete line 15. If you use code 1A, that minimum, that qualifying offer code, you don't have to do line 15. So, to me, most people will be able to use that 1A. You don't have to worry about reporting the employee share of the lowest cost monthly premium for self-only coverage, right? So if you have multiple plans, and let's say you have a high option and a low option, you would report the low option, the lowest cost plan that you offered the employee. Doesn't matter what they enrolled in, right? So they're looking for that affordability here. So that lowest share. But again, most folks I think will be able to use code 1A, not have to worry about line 15. If you enter code line 1A, it pretty much is clear, don't fill out line 15. So if you don't want to use 1A, you can use a different code and then use line 15. But they're kind of exclusive. Okay? They want you to include cents, so they give you the formatting. And if we do have some employers that still provide a choice or a plan at no cost to the employee, you would enter 0.00. Line 16, okay, this is series 2 codes. Again, we're still in that section 2, still dealing with offer of coverage. Line 16 deals with why wouldn't you be subject to a penalty for this employee, okay? In this case, if none of the codes apply, you can leave it blank, okay? The most common code you're going to use here is 2C. The employee was enrolled in coverage offered, all right? Code 2A, they weren't employed, so you've got mid-year hire, not employed on any day of the month. This is again where it gets kind of confusing. To consider it a valid offer of coverage, they have to be covered the entire month. So they tell you if you have a new hire that comes in on the 2nd of the month, even if your coverage kicks in day 1, on line 14, you're not going to report an offer of coverage, right? Because they don't have coverage that entire month. So it gets interesting. But you'll enter a code here to offset that. So there is an offset to where you would not be penalized, but it's just one of those, again, contradictions. So for offer of coverage, that offer has to be for the entire calendar month. Okay? When you're reporting on who's actually enrolled in coverage, we're looking for any day of the month. So again, offer versus enrolled, it's different. 2D, you have folks that might be in a limited non-assessment period, if they're in a waiting period, if they're a variable hour employee in their initial measurement period or their ongoing measurement period. Their ongoing, they would have that offer of coverage because they were already a full-time employee. But they want you to use code 2D here, right, to report that they're in a limited non-assessment period versus 2B. Because technically they're not a full-time employee yet, but they want you to use 2D to indicate that you're measuring them, basically. Okay? 2E deals with multi-employer interim relief rule. So I know we do have some clients that contribute to multi-employer plans on behalf of a collective bargaining agreement. Okay? So that's where this code would kick in. And then you've got your affordability safe harbors. and your non-calendar year transition relief. But again, the most common code you're going to use here is 2C if they're enrolled, and then the other ones for the exceptions. Part 3. Okay, this deals, again, self-funded employers. So fully insured, you can take a little snooze for a few minutes. You don't have to worry about this, which is nice. So part 3 is going to deal with your covered individuals. Who's covered under the plan? Okay, and you're going to have to kind of walk through this form, and it tells you right up top, if the employer provided self-insured coverage, check the box, and then provide the information. Okay, so check the box, provide the information, otherwise leave it alone. Again, you're only going to complete it if the employee is enrolled in employer-sponsored self-insured health coverage. Must be completed for all employees enrolled in that self-insured plan or plans regardless of their full-time status. So again, if you have part-timers on the plan that you offer coverage, you need to report them as well. You have to report spouses and dependents. So this is more of a belly button detail reporting versus just employee level reporting. You can also use 1095C Part 3 to report on non-employees. Okay, so you've got those kind of funky situations where you might have a retiree that you're covering under your self-funded plan. Don't have a lot of that anymore, but there's still some out there. A non-employee COBRA beneficiary. So maybe the spouse elects and the employee does not. Terminated employee receiving COBRA who terminated an employee during the previous year. So again, there are rules here and pointers about who you could use, who you could report on for those non-employees. Going into some additional detail, just kind of walking through the columns. Obviously, covered member's name, the 9-digit social, no dashes or spaces, okay? This is where the dependent social numbers are important. So hopefully our folks, as they've been out talking to you, over the past year or two, when you've been asking, what can I do to get ready for healthcare reform? One of the things is you need to be collecting your dependent socials. So hopefully you've gotten that information on most of your dependents and are ready to report it. If not, it's okay. You're just going to have to make some efforts to obtain that social, okay? If you make those multiple attempts, and I'll go into a little bit more detail in a minute, but if you make those multiple attempts to get the dependent social and you can't get it for whatever reason, you can use the date of birth. But that's the only way you want to put the date of birth on Part 3, is if you don't have the dependent social, okay? And they give you the format. If the individual was covered for at least 1 day per month for all 12 months, you can check column D, all right? So again, offer of coverage has to be for the entire month, but the actual coverage covered is 1 day of the month. So just to try to keep that straight. If they weren't covered for all 12 months, you're gonna have to do the month by month of where they were covered, where they weren't. Okay? One important thing to notice, when you're doing your employee statements, if you're sending out your employee statements, you can truncate the social on the individual statements. Okay, so you can show the last 4 digits and use X's or asterisks for the first 5 digits, just to make your employees feel more comfortable about socials being mailed and that kind of thing. But when you're reporting to the IRS, you have to use the full social. Okay, so you aren't permitted to truncate on the IRS forms. So a little bit more around those dependent socials. You have to make reasonable efforts to obtain per IRC code 6724. Basically, you have to make initial solicitation, so when they're first enrolled, okay? And then 2 follow-up efforts. So if I enroll somebody today, a dependent, don't have their social, and then I'm going to have to ask them again before the end of the year, and then I'm going to have to ask them again next year. And those interim reporting periods, I'm going to be using the date of birth, and ultimately, if I don't get it, it's not clear whether or not I have to continue to beat them over the head for the dependent social, or if I can continue to use the date of birth. But right now, the requirement is that initial solicitation, 2 annual follow-up efforts. Hopefully, you can get it at that point. If they're not enrolled, you don't need the socials, obviously. Okay? Just a note, the statements to the employees have to be furnished on paper by mail, send them with a W-2. unless they affirmatively, I can't say that word, consent to receive electronically. And so it's a little bit tighter than just the electronic distribution rules like that they have for summary plan descriptions and things like that. They have to actually say, yes, I agree to receive my 1095-C electronically. So they pretty much have to spell it out, otherwise mail it. Okay, to their last known permanent address. Okay, these simplified reporting methods, these are kind of fun. They seem, the more I look at them, to be more hassle than they're worth. Some of the pieces will help you, but some aren't going to make any sense because you're still going to have to do the 1095-C. So they're there if you decide you want to investigate them. So the first one is the qualifying offer method. And we talked about this one, that's that code 1A, and just kind of an example, that might be last year's number, 9238, it's close, is what that contribution would be. It couldn't be any higher than that for single coverage, right, to consider it affordable. So if you make that qualifying offer, minimum essential coverage, providing minimum value to a full-time employee at the self-only cost of coverage not exceeding that 9.5% of the mainland federal poverty level single poverty line, and you've made that minimum essential coverage offer to the spouse and dependents, you can use the qualifying offer method. So this is an employee by employee basis, right? It's not something you can use globally. And if they are made a qualifying offer, if you've made the qualifying offer to one or more full-time employees for all the months during the year in which that employee was a full-time employee to where you could have been penalized, then use this qualifying offer method, simplified reporting. And basically, the pros, the reasons why you might want to use it is you wouldn't have to report that cost of coverage on Part 2 of the 1095-C, line 15. You would use that code 1A on line 14. And you could provide the full-time employee a statement instead of the Form 1095-C. I mean, to me, it might be easier to have a streamlined process. You have to send the 1095-C to the IRS anyway. Why send a different statement to the employee? But some employers might think that statement might be a little bit easier to understand than sending the employee 1095-C, so they may want to use that and hope that they don't get the phone calls to that number listed on the form. So the statement basically says that they were offered quality and affordable coverage and they're not eligible for a subsidy out in the marketplace. But there's specific language in the instructions you would use for that employee statement if you chose to go that route. Again, the cons, you still have to file the 1095-C with the IRS, and you still, if you're self-funded, have to provide a 1095-C to full-time employees with Parts 1 and 3 completed. So you could skip Part 2. To me, easier to have a consistent process all the way through, but again, your choice on what's going to work best for your process and your employees and what's going to be the easiest to understand. If they weren't a qualifying, if the qualifying offer was not for all 12 months that the employee was a full-time employee, you can still use that code 1A for those particular months where the qualifying offer was made, but then at the end of the year, you wouldn't be able to use the statement. You would have to provide the actual 1095-C. So the second option for simplified reporting is the qualifying offer transitional relief method. This is 2015 data only, so a 1-year option to use this method, then it'll go away. Based on the entire full-time employee population, you can use this if you made a qualifying offer to at least 95% of the full-time employees for any month in 2015. Okay? Hopefully you did, but if you consciously are using that 30% slush, you may not have. You wouldn't have to report the cost of coverage on the 1095-C Part 2 and on line 15, so you don't have to worry about the cost of coverage. And again, you can provide the statement, but in this case, the statement would read, you might be eligible for a premium tax credit or a subsidy. Okay, so a little bit of a different situation. Cons, you still have to file the 1095-C with the IRS. And it does not apply to 6055 reporting, so again, you still have to, if you're self-funded, do the 1095-C, send to the employee with Parts 1 and 3 completed. So again, kind of weighing it up, is this going to help you at all? Maybe, maybe not. The 98% offer method is really tight. I mean, this is like a no errors, didn't miss anybody, missed very few people. So based on your entire full-time employee population, if you offered coverage to at least 98% of those full-time employees for all 12 months, and that coverage is basically quality and affordable, minimum value, and is affordable, then you don't need to ID which employees are full-time, okay? And that'll be as we kind of work through the other form. And you don't need to report full-time employee count on 1094C. Okay. Again, not a huge relief, but would help in some cases. You still have to file the 1095C with the IRS. You could over-report because you might end up reporting for some non-full-time employees because you're offering coverage basically to everybody. And if you're part of a control group, you would still have to identify the full-time employees. So, again, these are out there, but when Paul and Grant and I were kind of kicking them around, we just don't know that employers are going to use much of this, if any. Switching gears. 1094C, this is that cover sheet, all right? Part 1 deals with the applicable large employer or the ALE member, all right? Part 1, very simple. It's dealing with employer information. Again, this is the cover sheet, the transmittal form that will go to the IRS. You will notice on this form, it's actually asking on line 7 the name of a person as well as the phone number. So on the statement going to the employee, they're only asking for a phone number. On the statement going to the IRS, they want a name and a phone number. So you'll complete basically lines 1 through 8. Most employers will skip lines 9 through 16. They deal with designated government entities if a government entity is having another government entity report on their behalf. So everybody will skip lines 9 through 16. Line 18, total number of forms submitted with this transmittal. Okay, so this is my cover sheet and I'm sending how many 1095Cs with it. Right? And you send them through. You could have multiple 1094Cs with batches of 1095Cs with each, right? As long as they're unique. But every ALE member has to have at least one authoritative transmission, okay, that says this is it, this is the main transmission, and I'm going to put total numbers on this form. So you can submit multiple 1094Cs, but one of them has to be that authoritative transmission to the IRS. Okay? Each ALE member has its own independent obligation to file returns and furnish statements. Okay? A third party can assist, right? But you cannot transfer your liability. So I've seen some vendors out there that maybe are offering that. Not so sure that can be done. That says that the liability remains with the ALE, no matter who does the reporting. Each member's information from an applicable large employer side must be reported separately. So you can't combine multiple ALEs on one transmittal form. They have to be done separately. Okay. Part 2, the ALE information. If it is the authoritative transmittal, so you're filing multiple 1094Cs, but this is the one that you're designating that this is my authoritative transmittal, I need to, on line 20, enter the total number of 1095Cs for all transmittals, right? Because this is my big one, I'm going to give them the total numbers, okay? And then it's going to ask me if I'm part of an aggregated group, an aggregated ALE group. If no, you don't have to complete part 4, so that's a nice thing there. Certifications, I can't speak anymore, of eligibility. So here's where you're going to say if you're using any of those particular methods. The qualifying offer method, transition relief, 4890H transition relief, or the 98% offer method. All right, so you would check any of those that apply, or all that you're going to use. And then you have to sign and date it under penalty of perjury. Okay? Line 21, just for to have it there in writing, aggregated ALE group is a group of ALE members treated as a single employer under control group rules. Okay, so same rules that apply to the rest of your business apply here. The ALE member information you're going to provide monthly. Line 23, and starting as you go down, column A, and you're going to work across, is the minimum essential coverage indicator. So did we offer minimum essential coverage to at least 95% of our full-time employees and dependents for the entire year? For 2015, remember that's 70%. So it's interesting, the instructions right now say 95%, and then as you get deeper, like off of this line, they actually say, oh wait, you can use it for 70%. So if you use the 70%, you can check on that minimum essential coverage indicator, okay? Line B, if you use the 98% offer method of transition relief or of simplified reporting, you don't have to enter your full-time employee count, okay? But otherwise, you'll have to enter that. And they don't really give you any guidelines on column B of how to calculate that number. It's kind of interesting. On column C, they want your total employee count for ALE members, so they want all your employees, right? So here in B, I'm giving full-time. C, I'm giving total employees. For column C, they tell me I have to use the same day for count for all 12 months. So I can use the first day of the month for each month, the last day of the month, or the first day of the first payroll period in each month, but I have to be consistent, and they define that. But they don't give me any guidelines around B. Okay? Column D, if I checked previously that I was part of an ALE aggregated group, I'm going to also indicate here in column D. And then if I'm using any transitional relief under 4980H, here's where I would indicate that. And really there's two codes that you would use here. If we have any 50 to 99 employers in the room, you would use code A. And code B is for those that are 100 or more, that if a penalty were to apply, the A penalty, that overreaching all full-time employee penalty of $2,000, you get to subtract 80 instead of 30 from that calculation. So you would enter code B here. Okay, so those are the only two options for that column E on this form. If you're an aggregated ALE group and you check yes on line 21, you'll have to complete part 4, and this is where you're asking for the names and tax ID numbers of the other members of your control group, basically, of your aggregated ALE group. And you're supposed to list them in descending order of employees, is the guideline they give you. And I think they give you like 30 spots, and if you need more, I think you just have to copy it. But, I mean, those would be humongous corporations, I think, depending on how things are set up, so hopefully you wouldn't need any more space than that. Also on the 2015 form, when on the 1095C, where you're listing your dependents, each member that's covered, initially they only gave you 6, and then you had to complete, basically attach another one. They gave more lines for that, so there's another page that you can use there. So that was the other change that they made. So, lots of information, lots of numbers, alphabet soup. But I wanted to give a little bit more detail. That was kind of the promise that we made, was to try to get to some of the detail for some of the, as opposed to staying, at the 50,000 foot level, we wanted to come down a little bit. Obviously, there's a lot more detail to it, but hopefully you have some helpful hints that might help you as you're completing your forms, and know that we're here to help you. We can't do the forms for you. We can't, we're not accountants, but we can certainly provide guidance. We can find answers for you. We just can't do it for you. So the penalties, under Code Section 6721, if you fail to send correct returns to the IRS, $100 per each incorrect return, total fine capped not to exceed $1.5 million for each calendar year. Okay, no big deal. 6722 is the one where you would not provide the employee statements. Again, the penalties are same as above. But guess what? think it was last week before, kind of, I'm reading through my news feeds that come through on my email every day, and this Trade Act thing, this was kind of hidden in the Trade Act that just came through. They increased the penalties. The $100 is now $250, and the annual cap's now $3 million. And if you willfully neglect to do anything, basically, I'm not going to do this, I'm not dealing with it, the $250 penalty is doubled and there is no cap. So basically what they're telling you is, if you have a reasonable cause why there might be an incorrect return, or that somebody missed a statement or something, the penalties might be waived. All right, so as long as they're due to a reasonable cause and not willful neglect, throwing your hands up saying, I'm not dealing with this, they might waive the penalties. And again, if you make good faith efforts to comply for 2015, reporting in 16, then they're saying no penalties. So you gotta do something, or have someone do something. And as long as you're making that good faith effort to comply, you won't be on the hook for basically no cap, but at least $3 million, depending on the number of employees you have that are full-time. Okay? So the penalties can be pretty significant. I know there are some folks that are still kind of holding out hope. Okay, we King versus Borwell, darn, there went that one. Okay, what's next? They still could maybe delay this, but you gotta move, you gotta act on it, and just right now deal with it like it's coming and it's not gonna be delayed. Because if you wait until January and realize you have to do this, you're going to be spending a lot of time on these forms. So again, if you're filing more than 250 of the 1095Cs, you have to use the AIR system, the Affordable Care Act Information Return System. Only acceptable format to file these forms is XML. I'm not a computer person, but that's what it said. Each transmittal is limited to 100 megabytes. That's a lot. I think Paul initially, he wanted me to translate this, and he said it was around like 10,000. I couldn't really find anything on it, but it's a lot of forms. So hopefully space won't be an issue for most of you. So if you are over 250, or even if you're smaller and you're considering filing electronically, you need to register with e-services. You can do that now. And again, that's where they're going to want that personal information about you to register. It's not company level information, it's your information. And then you're going to submit an application for a transmitter control code. Okay? And again, just like the HPID, there's time delays and steps between each process. So you might want to think about, if you're not having a vendor do this, kind of starting it now. And then there's a testing process to make sure they can receive your files. And they'll give you confirmation back. So that's the electronic filing piece. Now I'm going to have Grant come up and give might not be a better subject, but I'm sure he will make it a little bit lighter. He's going to talk a little bit about the Cadillac Tax, and then we'll kind of open it up for questions for Paul, Grant, or myself, and see what we can do.
Now, we need to clarify if that was for Beth or for me. There's a very important reason for that. Paul's not in the room right now, but if it wasn't for me, every time that I see him for the next 15 or 20 years, he's going to remind me that you clapped for him and not for me. When we did our earlier healthcare reform presentations, every time they clapped for him, he'd come out saying, they clapped me. So Paul's quite a character. One follow-up with Beth's presentation is, how many of you know what they're actually going to do with this data? Well, from the people, from the IT architects that just had their system hacked for 24 million records, some of us in this room perhaps, they're designing a database that will have 330 million records on every legal citizen of the United States in it. That is a big target. They're going to marry in with your information, the IRS information, so that when an employer has the potential for a penalty, they can simply look at their records and say, yes, you did not offer affordable coverage to this person, or you did not offer affordable, or you did not offer basic coverage to 95% of your employees, therefore you're subject to this penalty, which is collected monthly, by the way. Even though it's $2,080 a year. They collect it monthly. Paul, they did clap for me. Also, when the individual goes to the exchange, right now, it's kind of a trust. Yeah, I didn't work, or I earned this much money, or whatever. I believe the number was about 80% of the people that had coverage through the exchange had to pay additional taxes when they filed their last tax return. So maybe they weren't being completely honest there. With the new system, they'll be able to check that out in front. So what could be worse than what you've sat here and listened to for the last hour or so?
Thanks, Grant.
Well, two things. Number one, Beth is giving free root canals following the presentation. And the bad news is there's no anesthesia, but after this, who cares? The only thing that's really worse about this, and this is something we've been harping on since this law was first enacted, is the Cadillac tax. And I want to do a brief advertisement before we turn it over to questions, and I appreciate your allowing us to push the questions to the end just so we'll make sure we cover all the elements of this. But the Cadillac tax is going to do the most to end employer-sponsored health care. It may not do it in my career, it may not do it in your career, but eventually we'll bring it to an end, because the way the tax is being set up, sooner or later you're going to have to throw up your hands and say, I simply can't do this anymore. The Cadillac tax is the source of revenue for the Affordable Care Act. Right now in 2018, they estimate it will fund $12 billion of the cost. In 2019, they estimate it will fund $20 billion of the cost. But over the first 10 years of the tax, it has to fund $1 trillion of the cost, which means the tax has to ramp up to well over $100 billion every year in short order. So it's going to be quite a burden for you. The tax. What is the tax? Now, those of you that are in publicly funded companies, just like the fully insured kind of had that point you can doze off, you cannot doze off in here. If you don't know it already, the tax applies to every employer, regardless of your tax status. So you need to stay with us as we go through this. There's two limits. Your single coverage is $10,200, and your non-single coverage, and it's deliberately worded that way, is $27,500. If your cost in any one tier, in any one plan, exceeds that cost in any 1 month, because it's administered on a monthly basis, you would be due a Cadillac tax for perhaps that individual. Doesn't matter that every other employee is under the limit. If you have one over the limit, you owe a tax on that one person, perhaps in that 1 month. It's an excise tax. That means you pay the tax regardless of your financial outcome of your operations. It's 40% of that excess amount, and it would be due with your tax return. Here's how they started out their February 23rd notice, saying that applicable coverage, it's another new term, you got DLE, you got low coverage, we're getting a whole new vocabulary here. Coverage under any group health plan made available to the employee by an employer which is excludable from gross income. And to clarify, a little later on in the release, they said that employee contributions are also included in that. There are a lot of employers saying, well, I'm not paying that portion of it, why should I be subject to that tax? This clarifies the fact that you would be subject to the tax. I have a short list of what's included because I don't want to spend a lot of time on this. I'll have some dates coming up that we are going to spend a lot of time on this, looking at the law, looking how it can impact you, and looking at options that you have that may help postpone this tax. Employer-sponsored medical and drug. Everybody here should know that your health plan is going to be subject to this tax. Employer pre-tax contributions to health savings accounts. That should not be a surprise either. If it is, we've got to add that cost on top of there. That becomes an area, we've got plenty of employers that maybe have a $5,000 deductible, but they give you $4,800 back in a savings account. Well, that's going to be included in the tax calculation. Employer pre-tax calculations to the HRAs, but they made one change here. If you have an HRA right now, you should be calculating your COBRA rates based on either the past cost or the actuarial value method. If you're not doing that, let your account manager know, tackle me after this. We'll talk about how we can get the correct numbers to you. It appears that the IRS is going to allow those to be used, which will be a little bit of a break because those two factors are lower than just on basing it on what's available. But here's the part that we didn't think would survive, but did survive their February release. Employee pre-tax contributions to HSAs. Employee pre-tax contributions to medical flexible spending accounts, not your dependent care accounts for those of you that are very protective of that, and pre-tax contributions to medical savings accounts. Not a lot of those left, but if you have one, employee pre-tax calculations or pre-tax contributions are part of that. Keep in mind the tax is calculated on a monthly basis. Keep in mind the tax is calculated on an individual basis. My wife has a test every couple of years, so we throw a few extra dollars in the HSA every month. When calculating the Cadillac tax, if you look at the potential liability from my coverage versus the person that sits right next to me, even though we may have the same type of coverage, it will be different for me than it would for them. That's where this starts to get really tough. Tax is calculated monthly, and it is your responsibility to determine the tax. Now, if it's a fully insured group, your insurance carrier is going to pay the tax. Even though they're paying the tax, you have to figure out what the tax would be. You have to report the information to them so they know what the tax will be. The penalties, don't have the slide here, but it's just as if you falsified or you made a mistake on your federal income tax return. If you file an incorrect tax filing, you'll be subject to the same type of fines and penalties. So they have some teeth in this as well. We've got a couple of dates for you to help with this. May not be as entertaining as Beth's because this is a very somber subject, but in Cincinnati on August 6th, in Dayton on September 10th, and in Columbus on September 17th, we're going to be doing a learning center where we're going to take about an hour and a half look at the tax. We're going to make sure you understand, for example, I don't think we have any in this room, but if you're on a modified community rating, how they change something in the regulations, that could be, bless you, that could be quite a burden for you because rates are dependent on age, and you have people just on the virtue of their age that have rates 3 times the size of others, so it could be a big tax there. So if you want to get registered for one of these sessions, please contact your account manager. I assume we have information out on the internet, but you can do that as well. With that, I think we're going to open it up for questions.
Okay, questions for Grant, myself, Paul is in the back. If you have individual questions, we can stick around afterwards. Yes, ma'am.
On the 1095 form?
There are rules around it. It's in the instructions, so it talks about, if it's an employee on COBRA and the family makes the election as part of the employee's election, then you would report them as covered.
Yeah,
I'm looking
it's
at
on the
Grant.
non-employee coverage section.
But it would be like under that non-employee, so they're not considered employee, so the codes would be different. But they talk about the different scenarios for COBRA employees, retirees. If you have a board of directors where they're not considered employee, there are instructions right in the IRS forms for that.
There's been a lot of chatter about COBRA perhaps going away too. It hasn't happened yet, but the need for it is greatly diminished because you can go to the exchange and get coverage that's probably less expensive. May not be as good as what your group plan is, but it's available out there for you.
Yeah, the reason why COBRA, would stick around, and it's interesting because I have a brother right now in the situation. He gave his notice, his employment's going to end at the end of this month. He's had some significant medical expenses. He's on a high deductible health plan. It's worth his while to COBRA because he's met his deductible. So at least COBRA through the end of the year, and then once his deductible starts over, then, it might make sense for him to go to the marketplace. But that might be one reason why somebody would opt to stay on COBRA versus going out to the marketplace.
As our company is exempt from COBRA, but we offer medical continuation, is that a player in any of this, or can we just go, phew?
I would think since it is continuation and the employee's covered, I would think you would report it just like
We still
COBRA.
have to count them?
But I'll see if I can find anything around that. It's odd because continuation generally applies to smaller employers who don't have this responsibility, so I don't know that it's even addressed. But I'll see if I can find anything about continuation. But in lieu of any additional information, I would think because if you have people on continuation that accept that coverage, And they're having that coverage continued.
Again, the forms are for the individual too, for the individual mandating stuff like that, and they use those forms for that purpose, so.
Right.
I would, if I was a veterinarian, I'd say,
You're
yes.
gonna counter.
Yep.
That's what I assumed, but I didn't want to assume. Thank you.
Yes, ma'am.
Who's making the public aware that they're going to need this 1095 for their taxes when it's time to file? Is it up to the employee, or is there going to be, some sort of media blitz about it? I mean, I see the smile.
It's part of the instructions. If you wanted a good stock investment, last year would have been a good thing to invest in H&R Block and some of those types of things. There's one of the forms, it might be that specific form, that's 1 page long, but the instructions are 16 pages long. So it's going to be quite a shock to a lot of people. First, they're not going to know what that form is when you give it to them. Hopefully they'll take it home, keep it. So you might want to keep a supply on hand when they lose it, but they will need that to file their taxes, just like they need all the other forms that would go along with their tax. But no, there's not been a lot of publicity about this from the individual standpoint. We've still got a lot of people in the dark about what the Affordable Care Act means to them and how it impacts them. We get questions all the time about how do I get in the exchange and those types of things. So it will be a problem.
Yeah, I mean, the first couple of years are going to be, everybody getting used to it, and then it's going to be just like the W-2 process is today, really. I mean, kind of going through that, I would think, over time.
So we, as a school district, have a lot of subsidies. At this point, none of them are over 30 hours. So those are not part-time employees, correct?
Those are part-time employees. But if you're including them on the plan, you need to use the code that says they're offered the coverage on the plan. And by offering them coverage, you've eliminated any possibility for them getting a subsidy on the exchange. So their only option would be to go through your plan.
But we're not offering them coverage.
Okay.
Because
Then
they
you would
don't meet the criteria for.
you would still need to report them so that when they went to get coverage on the exchange, it would say, yes, here, I'm a part-time employee here, you're confirming that, so that then they can say, well, okay, you're not a full-time employee, you've not been obligated to offer them coverage, therefore there's not a penalty to you. And then if they're eligible for a subsidy based on their household income, they can get that. But if you have the coverage over here that's affordable for them, then they can't get that subsidy, even though they're part-time.
But we have other part-time employees that are less than 30 hours that we do offer coverage to.
Is that part of a bargaining agreement? Or, yeah. Then if they went to the exchange and tried to get coverage, they would look in that record and say, well, you offered affordable coverage through your employer already, you cannot get a subsidy through us.
But we have to report all of them.
You have to report all of them, yes.
Okay.
So basically, if you're giving income to somebody, they're going to be reported on there. And that way they can tie it together. They can look and see, I mean, if you're a nuclear scientist working 10 hours a week, you're part-time, but your salary would look like something that is full-time. So they would need that distinction, that code to say you're part-time.
So any coach that, or any of those people, we need to report?
You need, yes,
All of them?
yes.
Okay.
So we still are allowed to determine full-time status over our window of 12 months. So they don't become full-time until they meet that bridge at the end of their 12-month period, correct?
Correct. If they meet that average of 30 hours per week, 130 hours per month.
Now, we're self-insured, so do I report all employees, like all 400, and then just check full or part-time, or am I only reporting full-time? Because we don't offer a plan to anybody who's not full-time that's met that 12-month criteria. Does that make sense?
All 400.
So we report all 400 and then just would indicate if they're part-time, they would be a part-time code?
Yes, yes. You don't
And
have
it
to, you
not-
don't
and
have to
not
offer them
offer.
coverage, nope. Now, there's also the code if they're a variable hour and they're still in that period. So depending on when your measurement period falls, you could have a case where somebody is maybe 6 months.
Right.
They're this variable hour, and now 6 months they were offered coverage because you deemed them a qualified variable hour employee. That's when you can't just check that first box and say
But
it's,
if we consistently determine it on X date, so
Yes.
October 1st, so, and we look at the average of 30 hours over the months they worked, so, we
Right.
calculate it, we don't have to consider them full-time until October 1st.
that's correct.
Okay, and that's still kosher?
Yes.
Yeah.
Okay, and we just have to prove that that's how we did it?
You want to
Correct.
document that, yes.
Okay.
As far as the actual reporting and forms go, first of all, are they going to be selling the forms, like they package W-2s? Are we just going to be able to go out to office supplies, or do we have to get it offline? And then also, are there software companies, vendors that are already gearing up to help us be able to print these 400, or whatever we have to do in the reporting?
400 would be electronic.
Well,
So-
we are actually under.
Good luck with that system.
Yeah, yeah.
The draft forms are already available online.
Okay.
I would assume supplies would be available the same way that tax forms are
Okay.
currently available. A lot of that is done online anyway, so you can either download them or complete them online. That we don't have the final forms yet, and the clock is ticking toward next year, and you're already well into the 7th month of needing to have that information. If there's any 51 to 99 employers in here who are thinking that this applies to you because of that relief for 2015 on the penalties, you were included in there still, so you have to file these forms. It's very important that everybody files them. They probably be graceful the first year, but I think after that, they're going to be coming at you with penalties. But
And are there software companies out there that have started?
a lot of the payroll companies are really stepping up to do this. Some of them are charging extra fees, some of them haven't made it public what they're doing with their fees, but the information, a lot of that information is in there already. They would just have to ramp up a little bit more, and they could basically push a button, process your payroll, push a button, here's your forms. That's probably your best bet, because the platform is there already. If you're not doing your own payroll, then let's talk about what we can do to help you find somebody that can help you with that filing.
There are companies that are doing this on behalf of employers, so you can reach out to your account manager and they can kind of help you figure that out. If you're a United Healthcare client, they did share some information that the entity that completes their corporate United Health Group taxes is actually providing the service for a fee. So we can get you some information on that if you're a United Healthcare customer.
For the Cadillac Tax, wellness incentives are included in the cost of the plan?
From what perspective? Is that a contribution difference?
Contribution to the HSA.
Yes, it would be included, yes.
Are all employees going to receive a 1095C, not just full-time? You would give it to all part-time employees, student employees, seasonal employees?
Right.
I was thinking it was full-time, so I was writing
Oh,
that
was
down
it
to
full-time?
check.
Oh, okay.
Yeah.
We'll check on that. I thought it was all, but,
No, I think what it is it's all full-time, and then part-time only if you have a self-funded health plan.
Yeah. Which makes more sense.
We don't offer,
If you offered a part-time.
I'm sorry?
we don't offer to the part-time.
Right.
So it's just full-time.
So only
When you say you have to report on all, utilities, what do you
Full-time.
Just full-time,
Yeah.
not part-time?
That's my understanding, unless, like I said, unless you have a self-funded plan and you actually participate in it.
What I'll do is I'll send out a clarification after this. You guys have it in writing with a piece of the regulations, because there was a little bit of confusion around that. I apologize, but to the knowledge as well, it's, all full-time employees unless you're self-funded and you cover part-time employees. And then it's only if they're on the plan, okay? Because you're not really worried about offer of coverage to part-time employees, because at this point, they don't need to be offered coverage.
Or because full-time employees are temporary, 3 months?
If they come in and this is where it gets a little dicey, and Paul may want to jump in, but if they're truly temporary and not seasonal, if they come in, it depends on what your waiting period is, number one. So if your waiting period is 90 days, then it's kind of an exercise, but
If they're not seasonal and you know they're walking in the door and gonna work over 30 hours a week, then technically you should be offering them coverage.
Kind of seasonal anyway, they only come in the summer. They're not exactly a summer type employee, except at the same time they are.
Well, and there's rules around that too. If the work can only be done during that time of the year, so there's a couple different.
The time our client hires interns.
And there's rules around interns. So, the interns, it doesn't matter just because it's when they can work, it's the type of work that's being done. So if you're bringing in that intern, for the summer, and they're working over 30 hours a week, and they're gonna be working over 30 hours a week to begin, you should be offering them coverage. Now the good news is most interns are still on mommy and daddy's plan and they'll waive off, but you would still count them in your full-time count and make them, that offer of coverage, and therefore have to report on them. Paul, did you?
Yeah, I mean, there's a code, isn't there, if they're in a waiting period?
Yes.
So that's what it would be.
Yeah, but it gets, the temporary intern seasonals, I have a group that, they had student interns that are musicians that or students that are employees that are musicians that kind of travel around and try to, and do performances. So kind of figure out how you would figure out those hours. So everybody has their oddball little cases that are going to provide some challenges.
What are the, what's a safe harbor for this temporary transition period where you need to hire somebody and they're not full-time yet, or you don't know if they're gonna be full-time yet? Like,
That's the measurement
evaluating
period.
them, the measurement period?
Yeah, if you have, they call them a variable hour employee. So if you hire someone that you're not certain they're gonna work full-time or part-time, depending on the standard measurement period for your other employees that are in that variable hour category.
So we have to set our policy then?
Yes, there is. And if you see me after, I can talk about how to get you some information on that.
Well, again, thank you so much for hanging in with us this morning. It's extremely complex materials. We are here to be a resource for you. I wish we could say we'll make your life easy and do the reports for you, but we can't. But we're here to help, so whatever we can do, let us know. Reach out to your account manager, myself, Grant, Paul. Thanks for coming.